These presentations will work a comprehensive bookkeeping problem both within Excel as well as within QuickBooks. Excel having the advantages of being able to see all the components and how all those components fit together to make the end product, that end product, the financial statements. QuickBooks having the advantage of being able to use forms, simple data input, and an automated system in order to convert that simple data input into the end product, the financial statements. We will work each component of the problem in Excel first and then work that same information in QuickBooks. Hello, in this presentation we will record the receipt of inventory with a bill into our bookkeeping problem in Excel, keeping in mind how this same information might be input into accounting software such as QuickBooks. If you would like more information about the QuickBooks Pro, take a look at our comprehensive course in the link below. We're going to take a quick look at software like QuickBooks and then jump back to Excel and record this information. If we were to enter this information into QuickBooks, we're going to imagine this process. We're in the vendor section of QuickBooks and we're just seeing the flow process here of the purchase of inventory. Remember that we are purchasing guitars, we're buying and selling guitars. That typical process will be that we'll have a purchase order and then we will receive the inventory and we're going to record the receipt of the inventory with the bill at this point. This is a little bit different than we might think of when we buy something from like Amazon or something. Typically the purchaser, if we're a single individual, does not have the ability or the authority to be able to say, I would like, or the power within the transaction to be able to say, I would like you to ship the goods. And then if I think they're good, I will approve them and I'll send you the check upon receipt of the goods. When we buy something, we typically have to pay for it first and then we get the goods shipped to us. At this time, if we buy in bulk or if we have this relationship with a vendor, it's often the case where the purchaser might have more purchasing power or more power in that negotiation to be able to say, I'm going to send out a purchase order, a request for inventory. Once I receive the inventory, then I'm going to count it and check it out, and if it meets our standards or it meets our request for the inventory on the purchase order, then we'll go ahead and pay the bill. So that's going to be what we're going to say the process is right here. That means that we already, in this case, sent out the purchase order, and now we are receiving the inventory with the bill. You can imagine the box with the guitar in it and the bills in there that we then have to pay. We didn't record anything for the purchase order in terms of our Excel bookkeeping process because we didn't receive the inventory and we hadn't made a payment. There's no financial transaction. In QuickBooks, we'd still have this process. We would enter this information to process the purchase order. And then when we go to the receive payments, it can then generate that information. So we'd say receive payments. Now we got the inventory, the guitar in the mail, and the bill is in there with the guitar that we received in the mail. Once we enter the vendor, which in this case is Fender, the vendor that we purchased from, we purchased our guitar, in other words, from Fender, that being the vendor. And once we select tab, it says, do you want to open the purchase order? There's a purchase order for this vendor. And that will connect the two. We, of course, don't have that in our Excel problem because there's no financial transaction for the purchase order and won't be able to populate the bill based on the purchase order. But in an accounting system and software, it can typically do that. If it does, then we would just select the purchase order, and then we would have all the information populated in the bill. Notice what the bill looks like. The bills are driving what would be done in most software where we just populate the bill and it does the or whatever form, whatever document, in this case a bill, and it would then use that to create the financial statements and the reports. So we just have the vendor. It looks a lot like a check, of course, except that a check would be decreasing the checking account. A bill means that we're going to be doing something to accounts payable, a liability account. So we got the vendor here, we've got the date, we've got the amount, and then the bill date. And then the important thing down here is we've got the items rather than the expenses. Items for QuickBooks means inventory items. This is what populated automatically when we were just clicking on that purchase order, because it pulled over that information from the purchase order, meaning it gave us the inventory item, which is an SQ in this case, a Squire, and we got one of them, $168 would all populate automatically then. It had been assigned to a customer, so we had to enter the customer in to the purchase order, which then populated in the bill here as well, meaning we purchased this guitar specifically for a specific customer in mind, probably one that came into the store and said, I would like this guitar, and we don't have the specific specifications that they would like. So we made an order for that, and then this is the purchase order that we have. We're going to record this in QuickBooks, and of course what we will then have to do is say the bill is going to increase accounts payable, and we're going to say that the other side then will be the fact that we got inventory increasing. The fact that inventory increases then means that we do need to track that inventory as well. We're going to have to include it in our subsidiary ledger. We also have a vendor here that we're going to have to track, say who we owe money to. So we will have to track that in a subsidiary ledger as well. Back to our Excel problem, we're going to go through this transaction. We had a bill. Remember, we got a bill and we got the inventory. So we are imagining we got the inventory, we got the guitar from the vendor, which happens to be Fender at this point, and we are going to record the inventory as well as the related bill. First question I typically ask, is cash affected? And in this case, we're going to say no, we haven't yet paid it. We got the inventory and we're going to record the fact that we owe money. I would then think about what we received. What we got is inventory. We got another guitar. So we're going to say the inventory then is an asset. We got more of it. Therefore, it should be increasing. We will increase inventory with a debit. So I'm going to copy the inventory, scroll down to the next transaction field we have. It's on A17 and put in the date of 2/14. And we will then put in right click and paste 123 inventory. We're then going to put the amount, which was 168. 168 is the amount that we actually paid for the inventory. We will then credit something for 168 and put a negative of that number. So we're just going to say negative of that number, or we could just put in a negative 168 as well. And we didn't pay cash, of course. Cash didn't go out. Checking account didn't go out. We paid by giving an IOU. We owe them money. That is accounts payable. So it's a liability representing the fact that we owe something in the future for something that happened in the past. This thing happening in the past being the purchase of a guitar. And we know that it's easier to think of what we received first, because it's easier to know what the asset's doing. It's going up. Whereas if we look at the liability, we may not know whether we debit or credit it unless we've done this for a while. So in any case, we have a liability here. We know we're going to credit it because we debited cash, but if we think through it, we know that liabilities have credit balances. The bad thing is going up. We owe more money. Therefore, we're going to do the same thing to it as its normal balance to increase it, that being the rule, which is a credit. So we're going to copy that amount. I'm going to put it on the bottom in B18, right click and paste 123. Going to go to the Home tab, do some formatting, go to the Alignment group, and increase the indentation. So there is our journal entry. We will still have to record the subsidiary ledgers, but before we do that, we're going to go through the process of posting this journal entry that we just journalized in the general journal to the general ledger. So in order to do that, let's freeze the panes. We're going to scroll up top, put our cursor in AJ1. We will then go to the View tab up top, Windows group. We're going to go to Freeze Panes and select the first item, which is to freeze the panes. Then we'll scroll down. We're looking for inventory. That's going to be the third account on the trial balance and therefore the third account on the general ledger. Scrolling over to that third account, we see accounts receivable. I'm assuming it's going to be under the accounts receivable. If I'm right, then that would be good. There it is. It's inventory. It's in AQ. We are in cell AQ24. AQ24 equals, we're going to point to C17. C17, it's right there. C17, enter. And that puts the 168, which increases the balance of 1,945 by 168 to 2,113. That then can be found in the trial balance. Scrolling up, there it is, 2,113. Scrolling down, we then want to post the accounts payable. First time I believe we've done that so far. Here's accounts payable. It's going to be the first liability account, so we're going to look for that first orange account. First orange account on the trial balance means also the first orange account on the general ledger. It's in order. Green accounts assets, orange accounts liabilities. There's the one we want. It's in cell AZ15. So we're in AZ15 equals, and then we're going to point to that 168, bringing the balance to 168. That balance then should be found on the trial balance as well. So here we have the trial balance, and there's the 168. Now we're going to scroll over and post the same information to the subsidiary accounts. Remember that the accounts payable represents who we owe money to. In other words, this means we owe money to people. Vendors is what we call those people typically who we owe money to in terms of accounts payable. And we also want to know more detail about that. We could get more detail from the general ledger as we can from every account, but it only gives us detail by date of transaction, and we want to get detail by who we owe, who the vendors are that we owe. So we're going to scroll all the way over as we have with the accounts receivable account and make a subsidiary ledger and really just post that same information. It's kind of like another GL, but it's in order by vendor rather than just by date. Here we are. So here is, we're going to have a new one right here. We're going to say this is a new vendor named Fender, who we buy guitars from. Fender's our new vendor that we buy guitars from. And we're going to say that that's a credit. So I'm going to post that same credit over here in the credit side in DE7. We're going to say that that equals the 168, and that'll increase the credit balance to 168. Then if we look at our total here, we're at 168. That should match what's on the trial balance. So let's go all the way back to the trial balance. Just double check that really quickly. So we're going to scroll all the way back to the trial balance. We see it there on the general ledger, 168. That's a good sign because that's what the trial balance is built from. And there's the 168 there. We need to do the same thing for the inventory. The inventory is here. It's in number. It's in dollar amount. But we know that inventory is actually guitars. So we need to back up this dollar amount with guitars and value those guitars with dollars somehow. So let's scroll over to our subsidiary type account for guitars. And we see this information here. We're labeling each guitar and tracking each guitar. We have an SQ guitar. So we're going to scroll all the way down. I believe this is a new guitar type. So we're going to scroll all the way down to the bottom. And here we are. So this is our new area. It's in CE88. We're going to put the date of 2/14. And then remember, we have three columns here. We've got the purchases, the cost, and the inventory. This is where we're going to put the new purchases. This is where we're going to put the cost of goods sold when we sell the guitars. And this is what is remaining. So these two are really the activity happening. This last one is where we are at in terms of the asset at the end of the day. So here we're going to say that we got 1 in terms of quantity. The cost is 168. So I'm going to tab over there and we're going to multiply that out. 1 times 168, which will be 168. So we're going to do that with a formula though. So we're going to say equals 1 times 168 and enter. And then we need to pull that same information into ending inventory. So this is really showing the activity, the journal entry. This is showing the ending inventory that is still left. So we're just going to say equals. I'm just going to use formulas again and say this equals that 1. This equals the 168. And then I'll multiply that out one more time. Equals 1 times 168. Then remember, we need to update this last formula as well because it's a kind of a static formula that we have to update each time. It's not a fancy formula that's going to update. So it's a nice simple formula. So it's just adding up all the end cells here. And so we added another cell. See, it's adding up all the end cells. We added this item. So we need to add that to our formula. So I'm just going to say plus at the end and point to that last item and enter. So if we were to double click on it now, we could see that it's just adding up all the end cells. If there's a problem with it, just delete it and go through and just add up all the last columns, all the last cells. So we're going to go check now that should add up to 2,112. That's what should be on our inventory items now. So let's go check that. We're going to check inventory on the trial balance. We can actually check it on the financial statements here. So inventory on the 1,000, it's $1 off. That's okay. That's rounding. 2,113, 2,112. If we check the inventory over here, let's check the trial balance. 2,113. So it's $1 off. That's okay. Looks good. Let's tie out our financial statements now. What we did is we did something to the payable, and we did something, of course, to inventory, which we just looked at. And we'll just see how that populates over on the financials and how it just generates automatically as it would in a similar fashion to in accounting software. Before we do that, however, let's unfreeze the panes by going to the View tab up top, Windows Group, Freeze Panes, and Unfreeze the Panes. Then we're going to scroll all the way to the right. We're going all the way to the right to find this information. Scrolling all the way to the right, we see that inventory has been updated as we think it should be. Accounts payable has as well. We see that total assets still equal total liabilities and equity. Nothing has happened to the income statement because we just purchased inventory. We have not yet sold inventory. When we do, it will be expensed in the form of cost of goods sold, and we will have the related revenue, of course, in the merchandise sales. We then have the statement of owner's equity, which has no change as well, that being no change on the income statement or equity. We still have the loss on the income statement of $346, that part of the statement of equities, part of the calculation of the ending owner's equity balance of $143,829, that amount found as well on the balance sheet. Hello, in this presentation we will record the receipt of inventory with a bill within QuickBooks Pro 2018. If you've been following along, that's great. We will be continuing with Get Great Guitars problem. If not, that's okay too. We're going to be receiving inventory with a bill, choosing this icon here, looking at what that will do, what will that record, and then take a look at the financial statements and see how they are affected. If you have the backup file up to this point, you can restore that at the File tab and restore the backup. We will be working with new data here, so if you're working along with the problem, it's good to have the new data as up to date as possible. If we're on the same page, then we'll be entering the data at the proper time, and especially the purchase order that was entered last time. So if you're following along with the data, you will need to have had the purchase order entered last time. Note we also have the open windows open here, and that is found at the View tab and Open Window. And of course we have the company homepage found at Company and Homepage, that being the only open window we have at this time, working through the home page. Now what we're going to do is create a receipt of inventory with the bill. So what has happened prior to this is that we have made a purchase order to the vendor. Now we're going to receive that in the mail. Note that this is a bit different than ordering something individually from something like Amazon, in that when we make the order, we haven't made a payment and we haven't received any inventory, and we're not going to make the payment, unlike if we're at Amazon, where we would probably make the payment at the point in time that we purchased the inventory. Here we're just basically requesting inventory with the purchase order. Once it is shipped, it will be shipped then with the bill, which we will then input, and that's what we'll do now. And then we'll make the payment on the bill that we have received. So we got the purchase order. We're going to check that purchase order against what was actually received. Take a look at the bill. Then if everything looks like it's in order, we will pay the bill. So in order to enter this information, we're going to say receive inventory, and we're going to say receive with a bill. Then we're going to choose the vendor that we're receiving this from, and in this case we're going to choose Fender. Now you could select the drop down and that'll have your vendors here. If you start typing in the name, we're saying Fender is the vendor, there is the vendor Fender, and we're going to say tab, and a pop-up should pop up if we are in the same data set, that's saying you have a purchase order for Fender. Would you like us to populate this bill with that information from the purchase order? We're going to say yes. Then we need to select the purchase order, that one being this 1003. Once we select OK, it should then populate the bill. So there we have this, and so we've got Fender, the bill, and we have the information down here being populated from the purchase order. I'm going to go back up to the top, and we're going to tab through this information. So I'm going to tab, go to the date range. That's going to be the 14th. So we're going to add the 14th. So I'm just going to use the plus button in order to increase the date day by day, 9, 10, 11, 12, 13, and 14. Tab, we're not going to include the reference number or any reference number. The amount should be pulled from the purchase order, that 168 being pulled from the purchase order. We're going to keep the bill due date at the 2/24. The terms, we're going to keep the terms and leave the terms, no memo. And then we have the information in terms of the item. Remember, this is an inventory item, and because we pulled it over directly from the purchase order, it moved to this items tab rather than being a bill that would be recorded on the expense tab. Notice, if we go to the expense tab, such as this, nothing is in the expense tab. When we go back to the items tab, that's the inventory item. So remember, the items mean basically, in essence, inventory items. Expenses typically are any other account that we will be creating the bill for. We then have the item number pulled from the purchase order, and the description. If we make this a little bit larger, we can see the description. Quantity is 1, cost is 168, the amount 168, and we purchased this for a particular customer, that being New Music. And we're going to say that this is billable. And that means that once we create the invoice, then we can populate the invoice from this same information, meaning we ordered this guitar specifically with a purchase order to Fender for this company, New Music Stuff. We have now received it with the bill, and now we're going to probably invoice at a future time, fairly soon, this customer at the point that we deliver the guitar to them. And then we can link this together, populating that invoice with this same information. So we're going to say, now, the other thing we want to look at is the journal entry that will be recorded from this transaction. Note we are entering a bill here. Whenever we have a bill, that means that we're going to have an increase in accounts payable. We're going to owe Fender the amount of the bill. The other side of it was an item here, meaning inventory item. So the inventory should go up by this amount as well. So we're going to save and close, and we'll take a look at that. Before we do, however, we might want to take a quick look at the purchase order. If we look at the purchase order, we're going to go back to the purchase order for Fender. Now it says received in full. So here's the purchase order that was generated, that was connected. It has now been connected, and it helped us to populate the bill, and we see that it has now been received when we go back to the purchase order. Closing this back up, we're going to close this. We're going to go to the reports. We're going to go to reports and company and financial. Take a look at the balance sheet. I'm going to change the date range. You're going to do that by the customize so that we can have a beginning and an end, so that when we drill down on the information, we will have a start and end. That date being 01/01/21, January 1st, 2021 to 12/31/21. And we're going to say OK there. Now what we have done is we entered the bill for inventory. So we should have inventory increasing. Here's the inventory asset account. If we double click on that item and scroll down, we see the New Music Stuff. So this looks like the one. We double click on that, and there is our bill for New Music Stuff. Closing this back out. Closing this back out. The other item that we have is a payable. We haven't yet paid for it. Here's the payable. We double click on the payable. There's the payable right there. Double clicking on that. There's our bill. Closing this back out. Closing this back out. We also want to see that payable information by vendor. So we could go also to reports. We could go to vendors and payables. And in this case, we could have an AP aging. Let's look at the vendor balance detail, and that will give us some information by vendor. Here's the bill that we currently owe there. This is the open vendor, the open amount that we owe in terms of vendors, in terms of accounts payable. Double clicking on that, there's the bill. Closing this back out, note that the total here, 168, in terms of the vendor balance detail, closing that, is the same, of course, as on the balance sheet. Going back to the Home tab over here, we are going to enter another receive inventory for a prior purchase order. If we click the purchase order to see the purchase order first and go back, here's the other purchase order that we have not yet received the bill for. That's what we're going to enter now saying that we received this Epiphone and these 3 Epiphones and the bills related to them. So we'll close that out, and we're going to go to receive inventory with a bill. And now the vendor is going to be Epiphone. And we'll choose Epiphone. I'm just going to type it in there, and it's going to pick Epiphone. We're going to say tab and OK. This, of course, saying, do you want to tie this to the purchase order? Of course we do. Tie it to the purchase order. There's the purchase order. We're going to click on that purchase order and say, OK, that's the one we want. And it will then populate for us. We're going to keep the date at the 2/14/21. Reference number, we're not going to have one. The 1,200 populated from the purchase order, that's what we want. Bill due, we're going to keep as is. Terms, keeping as is. Items, remember, is in the items tab, not in the expenses tab. This item being pulled, this information being pulled directly from the purchase order. We have the description, we have the quantity, 3 this time. The cost, 400 times the 3 gives us the amount of the bill, 1,200. Note that there is no customer here, meaning when we had the purchase order, we had not received a custom order for these. What we're doing is just populating our stock within our store. Then we have the number here. What's this gonna do to our financial statements? What's QuickBooks going to do when we record this? We know that by the fact that it's a bill, it means that the accounts payable is going to increase. We're going to owe more money. Accounts payable increases. The other side of it is, of course, the fact that we are receiving inventory, and therefore the inventory will increase by this amount as well. Let's close this out and take a look at that. Save and close. We're going to go to the balance sheet. And scrolling back up, we're going to go to the inventory item first. Here's inventory. Double clicking on inventory. We see this Epiphone. Double clicking on that information. We see our bill. Closing that back out. We see the other account here on the split column being accounts payable. That's the other account affected. Let's go take a look at it. Closing this. Scrolling down to accounts payable, there it is. Double click on accounts payable. There's our 1,200. Double click on that. Here it is here. Note we also want to see this, closing this out. We also want to see this in terms of who do we owe. For that, we go back to reports. We are going to go to the vendors. So we're going to go to vendors and payables. And we're looking for the vendor balance detail. And now we can see that there's that 1,200 owed to Epiphone, and here's the 168 owed to Fender, total being that 1,368. That then tying out to the balance sheet. If we go back to the balance sheet on the open windows here, back to the balance sheet, we see that that will be the same amount for the accounts payable.